Welcome guys, welcome to another episode of Funds Ki Baat ICICIdirect के साथ. Today we have Mr. Sandeep Tandon with us. He's the founder and CIO at Quant Mutual Fund. It's an absolute pleasure hosting you, sir. Welcome to our show. Sir, before we get down with our equity talks and everything, I would love to know about your journey and then we can take it ahead.
Okay. So I have been always associated with some sort of startup companies, and that's the genesis of my behavior thesis. So I started my career with GIC Mutual Fund as a summer trainee. Okay, I'm way back in 93, 94. I'm talking about very early stages. Okay, and this is time where we saw some about the macro thesis came into picture, because that's the time GIC did a JV with George Soros. Okay, the first time our macro understanding came into picture. Then I work with a startup company. On the side will be the Brennan and Coleman, the Times of India group, basically Economic Time Research Bureau, and I set up the infographics department, the colored newspaper which you see today. And from a journalist perspective, we brought the concept of management into it. So something again a very early stages. Thereafter, I was associated with IDBI Mutual Fund, again the first employee of IDBI Mutual Fund. So very early stages, I'm talking about way back in 1995. So from early stages, I moved to ISEC, where we did the derivative business. We started in the equity. So I was very early in that space, in the future options. Maybe the initial trades were done by us. So again, very startup sort of thing. Then from there, I also joined a other interesting company called Refco, which is the largest derivative house in the country. So derivative is something which we have grown, and it is close to my heart. Okay, from that background, we have worked on buy and sell side. So I work. But then from Refco, I moved to Goldman Sachs. So they picked me up for the Kotak Goldman Sachs JV. So I was part of that setup. Again, some sort of derivative activity got built up. New initiative was built on the custom clearing and side. So it's sometime always you be associated with something new. And again in 2007-8, I started Quant. Okay, the whole thesis about Quant is that what traditional approaches or houses are not doing. So we brought the concept of same liquidity analytics or risk appetite, sentiments gave into picture, and that is what we are still practicing. So again, starting point is startup, so very early stages connected with startup companies. So and always with a new fresh, what we call it, a mint fresh approach, and that helps us.
Absolutely. Viewers, to be very honest, Quant has been one of the phenomenal performers in the market. If you see the 3-year returns of the funds, they're more than 40%. So Quant Mutual Fund is the best performing mutual fund, I can say that. So sir, since we are talking about Quant, which fund, like someone would be wondering which fund to invest in right now, because since the returns are so high. So any funds from your end that can be recommended for our viewers at the beginning?
So in today's only our monthly call, we talked about, the time has come where we have seen the skewness towards mid and small cap, which happened in last few months, has been settling down. Those are the areas where we see some amount of correcting, and the large cap is coming back. This is again a time to look at the multi-cap area, where the Quant Active Fund is the name which comes to my mind, where we have a multi-cap strategy, where we have a compulsion to participate 25% large, 25% mid, and 25. So it could be a good balance type portfolio if you want to make it. It's a good opportunity. And in the same thesis, somebody is looking for taxation aspect also. The Quant Tax Plan also fits very well. And so is the case with, we can even talk about a flexi cap sort of thing. So I think time has come to look at a more balanced portfolio as compared to skewed portfolio, what we have seen in last few months towards mid and small. The time is more about the active style of money management. Absolutely. Or the Quant Active Fund.
Absolutely. So sir, my first question comes in, which every investor right now has. We are in the all-time high territory, and you are in the market from past more than 20 years. You have seen many all-time highs territory, many correction phases, many upside phases. So at this moment, what is your take on the market? Are we are near to 20,000 right now, and we saw a correction today when we are recording this. So if someone is looking to invest right now in the markets, is this the right time, or he should be waiting for more correction?
Okay, so let me put this way. In my 30 years of my career, I came in actually in Harshad phase of 1992. That's the way I started my career. In my 30 years of career, I have never seen such a strong Indian macro. Okay, both on absolute basis and relative basis. So I think India is a great opportunity if you have to talk about from a medium to longer term perspective. And there is no signs of any classic signs of euphoria. What happened, let's say in 2000 or 2007-8 or something in 2018, or maybe as recent as September 2021. There is no perfect signs of euphoria where one should say that one should be slightly worried about market. Absolutely. I am not seeing anything. Rather, India remains buy on dip strategy, and because of given whatever changes is happening, so we are calling that this decade belongs to India, maybe the half century belongs to India. So that is the bullishness level. But again, I'll always say that no moves are going to be linear like this. You know, you will see bouts of volatility.
Yeah.
And as a money manager, mutual fund being one of the most tax efficient vehicle we have, it's up to us how well we can capitalize these sector rotation or stock rotation in a very tax efficient manner. I think that's a great opportunity as a mutual fund vehicle we are bringing. So we remain very constructive about India. So India remain buy on dip strategy for us.
Though, sir, you've spoken about the strong macros that India has. We have seen a lot of geopolitical events that are happening.
Yeah.
The recent Russia-Ukraine war in 2022 and the Israel-Hamas situation which has come up recently. So, do you see these geopolitics or the world scenario affecting us, or it's just a matter of time that we may just move up from here?
So, very interesting. So, let me put this is the first time actually India is the beneficiary of this high geopolitical environment. Let me answer this in a very different manner. You know, the key question comes when we talk about whether geopolitical volatility is peaked out or not. Okay, so I'll answer in a very different perspective. We work on a concept of market employed analytics. So right from 2018, we have been saying that, rather in 2017, we talked about that 2018 till 2023 will be the volatility expansion phase. And how we predicted is based on some of the analytics we talked about. This is the time, that 5 years time period where geopolitical volatility will on the higher side, much before it really happened. And how the employed was, or the various asset class, we talk about currencies, commodities, equity, it played out quite well. We believe that we are in the peaks or the culmination phase of that cycle. Okay. Our own expectation is that by mid-November or maybe on higher side end December 2023, that cycle will peak out, which means geopolitical volatility in maybe in 2024 onwards will be on the lower side. Okay. So it should be, in fact, the way we are looking at it is an opportunity to participate. Because of this geopolitical volatility, you are getting opportunity. Now, a lot of data points are in our favor. If you really look at this time, despite Middle East tension, the crude prices has not rallied. Okay, the NYMEX crude has not able to cross $90 also. So people are generally worried. We are very happy that at least despite such a big negative news, the crude prices have not rallied. Okay, yes, gold spike is a more of a again, I look at whether you look at these data points as a starting of a new direction or peak of the cycle. We are looking at the peak of the cycle. We think gold has potential to spike further and it should peak out. So we are in that final cycle of peaking out. Something similar we are observing in the yields, 10-year yields also in the final leg of peaking out. Okay, crude can give you some up move, again it can correct further. So I think multiple data points which we look at, and then I look at the India risk appetite indicators, which is largely macro, is also very supportive. So we are actually made a call today. It's a all perfect background for a risk on rallies on a horizon. Okay, so it's an opportunity to go all out and invest money. Okay, and where now look at the behavior side. It fits so perfectly. Everybody is so worried about it. As long there is a fear, it's good for the market. Okay, I always say dar acha hai.
Yes.
Okay, dar bahut acha hai. Yes. Okay, if there is no fear, then you are complacent. And today the best of the people are worried. And the beauty of this time is that retail participation is very unique. They are in the driving seat. Retail is not worried because they were early participating on 2020. They are sitting on huge mark-to-mark gains. So their participation remain very thing. Look at last 2 years or 3 years FIS selling. Who has absorbed the entire retail? So retail guys are become very mature now. So very happy. We always say this decade belongs to retail investor.
Absolutely.
This is a great opportunity for their wealth expansion, and that is our focus. We also go all out and say this is the time. At least this decade belongs to you. You should not miss out this wealth creating opportunity. But the problem sometimes is like people get too excited at the peak of the cycle, and event like this today, they give up at the bottom of the cycle. So people should not withdraw money, rather. But I'm seeing a change in the mutual fund industry this time. Retail behavior is very different than what we have seen in the past.
Post 2020, like post COVID, we have seen a more mature participation in retail, and that has been an inflection point for retailers. Sir, we have spoken about the geopolitics and the world scenario that is going on. Like the beneficiary for the India benefited from a very stable political environment also since 2014, because a single party was in majority, and a stable political scenario is also good for the investors. Right now we are moving into elections. We have the general elections in 2024 and 3 important state elections coming up. Do you see these events also getting will kick in a lot of volatility in the market, or do you see it's like a normal 5-year thing which is coming up?
So as first point, I talked about that geopolitical volatility or the volatility expansion cycle will peak out in September or rather December 2023 on higher side. That's the point number one, which means overall volatility cycle or the data points will get slightly compressed. Now, I am not a great believer of that the state government affect the central government election. Okay, the volatility in the market is much more when you have a central government election as compared to state government election. Okay, even let's say the current government lose the, let's say, few states also, it doesn't make much difference. I don't see the state government election have any meaningful impact in the market, and hence hardly any impact on the volatility. Maybe closer to maybe May 2024 election, you might see volatility spikes up. So maybe at that time one should look into, can talk about these data points, but at this stage I don't think one should be worried about it.
So one can always invest when there's a dip in the market. That has to be the strategy right now. Perfect. So sir, let's move on to sectors right now. So any sector that you're bullish and sector that you are cautious about, so you can just talk about it.
So let's understand from the Quant style of money management. When we talk about our money management philosophy, we try to identify stocks or sector which are in the neglected phase. Okay, from a behavior perspective, we call it neglected phase or the most hated zone sometime. And we try to sell the sectors or stock which are in the admired territory or sometimes say most admired territory. So if you look at from a current perspective, we believe energy as a sector. Okay, we have seen some amount of up move in the power stocks, but if I look at the larger thesis of energy, which includes oil and gas sector also, so energy as a thesis is an extreme neglected zone, followed by media is again neglected zone. Pharma was in extreme neglected zone a few months back, still remain in the neglected zone, not in the extreme side. And so is the case with other names like metals. Metal was also in the most hated zone, if I have to define it, still in the neglected zone. So anything which is, so I like the company like energy, media, have to call it pharma, then even real estate was in the neglected zone for a long period of time. These are the sectors which we like from the current levels.
Yeah, I think in few funds, the highest allocation is in Reliance Industries. That speaks for itself.
Yes.
Any sector that you think is better to avoid at this pace? At this time, sorry.
I think we have turned slightly cautious on the financials, particularly in the banking side. Okay. So like industry average will be 35 to 40% weightages. Our weightage in the banking is less than 4% currently, and which is also predominantly either small banks or the PSU bank. So our worry is about this sector despite best numbers, okay, because of grossly over ownership. This is the one area which we have concern. Okay, this have not made a lot of money for investors. Okay, despite the consensus has been very bullish. So one area where we are cautious because the two important aspects. Valuation wise, yes, they are attractive. They are not very expensive. But if I look at the other data point like risk appetite and liquidity, so liquidity cycle has peaked out for the banking, and so is the case with risk appetite. Risk appetite has actually started shrinking for the sector, and that's the reason we have pruned down our exposure in this sector. So we remain. I'm not saying I'm negative, but it will not deliver desired results, so it will be underperforming for us.
And we've seen the results right now. The NIM is also not picking up, so probably there has been a peak out in terms of valuation for many banks. So next question is the most talk sector these days, IT sector, which has seen a big downfall since calendar year 2022. And with the advent of Chat GPT, AI, and all these buzzwords that are doing the rounds, do you find value in IT companies right now, or it's better to avoid at this juncture?
So in September 2021, we were quite early in spotting that some of valuation top in the IT space, particularly new age companies, and we were first mutual fund to exit it completely. Now we have started adding some exposure. The way I look at is that whether if you ask me, IT sector from a most admired territory has collapsed to most hated zone, answer is big no. Yes, they have corrected, but I think the extreme neglected zone, I don't think it has reached there. So it has potential to go up to those level, whatever reason, if global markets corrects or something like that happens, a potential. But I think the time has come to nibble in this sector, and maybe wherever valuations are attractive or some of the stocks have reached some amount of under ownership, those are the areas when one can look at. Maybe could be instead of looking at the services company, one can look at some of the product companies also. So early stages to take a very big call, but definitely we are not negative from the current levels.
Absolutely. And sir, one more on the sector only. What's your take on the new age companies? Because you have been bullish on a lot of new age companies. What is your take for these companies?
So, frankly speaking, we have avoided this sector for a while. We never participated in any of the new age companies. Okay, because at Quant, when we talk about, we try to look at the combination approach. So we give one third weightage on the valuation analytics, one third on risk appetite, and one third on liquidity analytics.
Okay.
So if you look at the valuation thing, they have been very expensive. So irrespective of their perception, and then what we also identify that around September 2000, or maybe in the calendar year 2024, there was a flood of these issues.
Yes.
Okay, there was urgency from a behavior perspective. It's a very classic sign, and I have, as a house, we have taken a conscious call, not on our gut feeling, but on data driven approach, because new age companies are listed globally. When we try to analyze the global data point, then we realize that this is the stocks which will not make money, and good we didn't participate. The stock corrected like 40, 50, 80%
Yes.
also. We have a view that if they correct further, or if some opportunity emerges, we look with open mind. But as of now, our exposure is zilch in this space.
Okay, absolutely. So these were the sectors that one focuses on, and how to buy, like what makes you buy a certain stock. But a very important metric is to when to exit from a certain sector, and exit strategy is not spoken about in the market. So how do you decide to exit a stock?
So it's actually a very interesting point. If you look at any media conversation, everybody talks about this is a stock, this is a sector they identify, and it's a case study to be discussed, but nobody discuss about the exit part. Okay. So at Quant Mutual Fund, what is very important, we always say buying is the art. Okay. You can observe and you can buy, but selling is a data science. Okay. Selling has to be done through numbers, okay, not through emotional attachment. Because what happens, any stock or sector you have made money, you do get emotionally attached.
Yes.
Okay, and various reasons. Some people even go up to that extent. This sector has been very lucky for me.
Yeah.
Or this is where we have big money. This is a stock, So they try to, get so much emotionally attached with that sector or stock, and that's a problem start. Though we all know one should not be, but it never happens in real life. So our strength comes from the background that we are good in selling. Okay, exits are more important than the entry points, and this is what we educate investors. And mutual fund being a tax efficient vehicle, this is the best thing you can do it. Okay, as an individual it is not very effective. As a PMS or AIF it is not effective. So I actually wonder why some of the large investors, ultra HNI, don't participate in the mutual fund business. This is the best vehicle which they can get it, and I think over a period of time they will understand. Okay, and at least we are putting a lot of efforts in educating about this structure. How is the opportunities there globally? This is the best vehicle which is available.
Absolutely.
So one should participate for that,
and
that's the reason we say churn is good.
And who better than a fund manager knows when to exit, because he knows everything. He has all the data points and everything. Rather than a retail investor, a fund manager is much better equipped.
He's more equipped.
Exactly. That's absolutely the case. Sir, you spoke about your derivative journey, that you started with you come from a background of derivatives, and post 2020 we have seen a shift towards, we have seen an influx of participants in the market, and more or less a lot of people are more inclined towards futures and options, if you see. And recently SEBI came out with a report that almost 89% of the people are losing money, and that is almost 9 on 10. So what is your advice and what is your take on this side?
So I'll tell you, this is a global proven data point that 90% people lose money. In fact, if I have to look at maybe in terms of number of investors, 99% investors actually lose money. It's only that 1% people who make money because of their share value, it looks on a higher side. The way I look at these data points, one should definitely try to understand, one should definitely participate, because otherwise how you will learn?
Absolutely.
If you don't participate, you will not learn. But everything is very important, what allocation you give, okay, from your overall portfolio. If you want to learning, maybe starting with 1%, 2%, at any given time, it should not be more than 5% if you are in the early stages. Once you gather momentum and you start understanding, okay, because option is equally risky business. Okay, people like very days, I am writing the option, I am buying the options. Okay, so it's a little amount, but it can wipe out your capital. Any event happens. Okay, so I think those are the people have not understand, because sometimes once cycle plays in your favor, you feel so happy that this is the only thing, this is the best thing I can do. Okay, but in other cycle it can wipe out your capital also. Okay, so very important to understand the allocation which you give. Okay, and I always say, if you over a period of time have built that capability or start understanding risk associated that, Then you increase exposure to 5%, 10%, 20%, depending on your understanding and your success.
Yeah.
Okay. So it will be too premature to say that one should not participate. At least I'm in that camp. Like, we participated, we learned from that. It's a very unique instrument. Derivative instrument can be used for leverage, can be used for money management instrument, it can be used for hedging. It can be used for going long also. So it's up to us how you want to use this instrument. Okay. So I'm thinking it's a good equity instrument which is there, and maybe as a house, like, we have started using a lot. Okay. But the challenge is that one should not get very excited that particular phase you have made money. So now you have arrived in life, and there's where the problem starts.
Exactly, and people use it as a casino ticket. So and that's the main problem. And options as a whole was an instrument made for hedging your own portfolio, risk on your portfolio.
Correct.
And people do not take it that way. So sir, we have completed almost everything, but we've spoken about markets, your journey, everything. But we wanted to know, what do you do when you do not track the markets and outside the equity environment?
See, to be very candid with you, being in market, we have to read a lot. We see a lot of stuff on the internet or Bloomberg or Reuters. So in leisure time or for a change, I like to listen to the music. Okay. Traditional music in the night. Say every night I listen.
Okay.
Okay. It's not once in a blue moon. So I don't sleep without that. So it's a good chain, it cuts you off from your day to day. So I like traditional music. I like ghazals and very Indian centric. So we listen to Western music also, but we are more of a traditional person. So I like old songs, old movie songs. So it's and even instrumental also. Okay. So music is something which is very close to my heart, and it's a great stress reliever.
Yeah, absolutely. And anything, any reading list that you have, or you're reading something recently?
See, I tell you, I'm saying, since we have to read a lot. If you're doing our research, reading is a part of our journey. Okay. I'll prefer to read more articles, the recent thing, rather than the books. Okay. Because books is most of a postmortem analysis. People do it. Where if you read recent article with the best of the people who provide you, they give you much better insights. So I'm a more believer of reading the current affairs and the analytics. Not so much stuff is available. Okay. We think we hardly use 10% of a Bloomberg article which is come. So time is very limited. So we try to optimize as much as possible.
And many people say that Bloomberg in itself is an ocean that you cannot consume it at
Correct.
once.
We say we can't use more than 10% of that. And 10% is also on higher side. People use it, Otherwise, industry average is very small.
Yeah, absolutely. So yes, guys, this was Mr. Sandeep Tandon. It was an absolute pleasure hosting you, sir. Thank you so much for being with us. Thank you so much.
Thanks.
Thank you.
Please note, mutual fund investments are subject to market risk. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.